Welcome, ladies and gentlemen, to realestateinvestormba.com. At Real Estate Investor MBA, we strive to provide valuable information from various experts within the business and real estate community, covering real-time market and economic information as well as curriculum-level material within various real estate investing niches. We aim to be relevant, straightforward, and forthcoming with actionable information for our community. And here's your hosts, Tejas Gosai and Jeremy Moyer.
For all that great information. I hope everybody caught some of what he said. I dropped a lot of great information. You know, when I started investing in real estate over 10 years ago, I did it for the exact reasons that David just presented here. Just to name a few, you know, generating additional income streams, also making inflation work for you. That's a big cost, as David mentioned, instead of against you. And then also the multiple tax benefits, just to name some. But anyway, thanks so much, David. So let's introduce Tejas Gosai. In addition to being a partner here at Real Estate Investor MBA, Tejas is also one of the managers of the newly formed Lehigh Valley Private Equity Fund, which is an evergreen $250 million fund endeavoring to provide a 7% preferred return with an overall annualized target return of 12% through lending and acquisitions in real estate. Tejas is also the head of the Tejas Gosai team at Century 21 Kind Partners, Realtors, based in Bethlehem. Tejas.
Awesome. Thank you very, very much for that awesome introduction, and thank you for everything you've done so far. David, you nailed it. First, I wanted to just say that this is a private equity fund. We had to keep a lot of this secret for a very long period of time, and over the past year, we've been building what will conclude our presentation with a business plan, and we want to go through some of that. So first, there's a disclaimer here, if you can take a moment and read that. Wanted to start a little bit about the area. So this is dated, but this is a September 20th, 2016 article when the Lehigh Valley had grown all the way to a $37 billion GDP. And it was the 65th largest economy in the country, or actually it was the 73rd largest economy in the country. And we're now over 41 billion, which we're going to talk about in a moment. So before we get into that, here's a quick video. Here's our website. I'm just going to pull this up and press play. Bear with me for a moment.
Welcome to Lehigh Valley Private Equity Fund. Lehigh Valley Private Equity Fund is a Regulation D evergreen private fund designed to provide a 7% preferred return and an overall annualized target return of 12% through diversification in lending and acquisitions in the real estate industry. With over 100 years of combined real estate, investment, and management experience, our management team is actively sourcing opportunities and improving real estate in the Lehigh Valley and surrounding regions. The Lehigh Valley is booming. The private sector GDP is larger than 112 countries, standing at over $41.2 billion annually. Lehigh Valley Private Equity Fund uses three methods to create returns for our investors: qualified lending, buy and holds, and rehab resell projects. Our philosophy is simple: quality over quantity. Our primary goal is to protect our investors, and our strategy is to produce consistent high-yield returns. Thank you so much for visiting us. Contact us easily by visiting www.lvpefund.com or call us anytime 24/7 at 484-362-1313. Thank you so much and have a beautiful day.
The next part of this is who we are, what we're doing, and to get into that, I wanted to introduce my partner, Jeff Sella, who isn't doing anything new here. He has been in the banking world for a very long period of time, And we'll kind of unpack that as we move forward with this information. But Jeff, I'll turn it over to you.
Yeah, thanks, Tejas. So the Lehigh Valley Private Equity Fund, as we've heard, is a Reg D evergreen fund, and preferred rate 7% with a 12% target. And these rates are not guaranteed. However, this is a range we believe we can deliver to investors based on our experience. I've been doing this for over 10 years now, and those are very reasonable rates that we can produce for our investors. And we're going to generate these rates in a couple of ways. As Tejas pointed out in the video, qualified lending to real estate investors. These are going to be short-term bridge loans. They'll be used to purchase and renovate investment properties and commercial properties. We're going to talk more about that in a little bit. The fund will also purchase properties for a short-term hold. These will typically be things that the fund is going to rehab and resell, which is really a booming business right now in the Lehigh Valley. And the fund will also acquire certain properties for long-term holds as rental units. And those opportunities are also very prevalent here in the Lehigh Valley, as there's kind of rotation from investors that have been carrying these things for years and years that have decided now is the time to get out. And Tejas knows a lot of those folks, and so the fund will have the opportunity to acquire those. Back to you, Tejas.
Awesome. Before we jump forward, though, could you just talk a little bit about, because you have the experience, the difference between a Regulation A fund and a Regulation D fund, and then why we chose an evergreen fund?
Yeah, so the difference between the regulations is Regulation A allows non-accredited investors into the fund. However, there's certain restrictions on advertising, and you do have to go through an extensive process, what they call a qualification process by the SEC and the states that you're operating in this case, Pennsylvania. As far as the evergreen aspect, anytime you're in the lending business, it takes time to build a lending portfolio, and it kind of builds momentum over time. And so you want to have an evergreen fund that continue to attack those lending opportunities. And even as the market changes, there's going to be continuous lending opportunities. There always are. And so there wouldn't be the best interest of the investors to suddenly have a maturity date where we'd have to stop lending a year or two in advance to meet that maturity and dissolve the fund.
Awesome. Thank you for that. And a lot of that information, again, is available on our website. Earlier, David said something great about financial freedom, and that's one of the reasons that we came together to pull this off, to try to keep a high, consistent return. And I get to talk about some of that. If you want to go to the next slide. Because this market has been so good, that's why I wanted to start with, in 2016 and 17, the GDP has excelled so much. But I saw a lot of that personally in our real estate business, as somebody who is writing 20 and 30 contracts or reviewing 20 and 30 contracts a week. We're constantly in touch with appraisals, what's going on with the lending institutions. And I have a residential division as well. We've had so much activity. It's really difficult to explain it to an outsider, I would say, unless you spend a little bit of time and unpack this. The significance is really overwhelming. And John Levine is awesome. His title is Chief Investment Officer, but the amount of time, effort, and energy he has put into learning the minutia of the Lehigh Valley is amazing. So with that said, please, I'll turn it over to you, John.
I want to welcome everybody here this afternoon. Thanks so much for joining us. Just wanted to say that we're in our fundraising stage, and it's an exciting time for us in the fund. And at the end, we hope that you obtain more information by requesting the PPM, and then we'll be working in depth, talk about what we're trying to do. So let's talk about the Lehigh Valley just briefly, because Tejas had given some great stats. It's a great place to invest money. There's many investment opportunities, and as Tejas, and my job is really what Tejas is able to source from buyer opportunities, seller opportunities, different kinds of real estate, multifamily opportunities, from what Jeff has seen in terms of the loan market. And my job is to take all this stuff together and to review it and to make sure that it fits our portfolio and what we are investing in. So we're going to talk a little bit more about how we do certain things. But again, Tejas on the real estate side, with his experience, with his team, his processes and procedures and what Jeff has been doing so successfully for the past 10 years. And lastly, we want to work with people like David, who is very knowledgeable about his side of the business, and we want to continue to grow, in addition to who we already work with, our circle of people to produce and maintain an evergreen successful fund. Tejas?
Yeah, let me harp on a couple little things. Because the Valley has been so prolific, I would say, and we all went through this period where we saw so much growth and then COVID hit. And from a real estate standpoint, we did have a little bit of a break, but things almost compounded when it came back on. Like, our phones are ringing off the hook. There are people looking, multiple offer situations, just like it was before COVID. A little funny statistic, but there was an open house at roughly $250,000 home. There was 86 people there in early February, before COVID hit. And so, the whole country, everyone took a little breather, but now we're going so far beyond where we were. It's kind of hard to explain that to people. And I think that this Valley is insulated from a microeconomic level versus what's going on nationally or even regionally. John, can you talk about that?
Well, I do believe that. Let me start at the end with some stats. Let's take trucking, which is a great subject for this area. They're pre-COVID, and they take and analyze through the major highways that go through Lehigh Valley, the number of trucks per day, the number of trucks per week, month, whatever. There was a dip during COVID, and we're back up to a level that is higher than pre-COVID. So it's just one example of, the resources are here, and the insulation comes from the fact that people want to be here, they want to work here, they want to distribute here. And as we'll again talk about a little bit later in terms of availability to build, municipalities who want to work and build. And, I listen into, there's 42 municipalities within the Lehigh Valley, so as many as I can. And they are approving zoning, subdivisions. If you listen to the Lehigh Valley Planning Commission, and if you go to our site, you're going to get there's some redirects to go to the Lehigh Valley Economic Corporation and all their information. And so we keep on top of that. But basically, as Tejas said, they did a great job working remotely, and government authorities working remotely to keep business open. And now we're basically back processing kind of all those things that did take a hit. So they just...
Yeah. So movement. That's the big thing we're trying to get across here. It's a lot of movement here in the Lehigh Valley, and being a multifaceted economy, right? The Lehigh Valley has 3 cities. We have Allentown, Bethlehem, Easton. We have 22 that goes above. We have 78 that goes below. We have the waterfronts. We have universities, walkable city centers, so on and so forth. So talking about the just how much activity there is in my team alone, last year we helped buy and sell about 180 units altogether, which was incredible for our team, and it was our second year as a team in the Lehigh Valley. Previous to that, we were individual realtors, but now what we've seen is more and more people from New York, New Jersey, Connecticut, Maryland, DC. And COVID was actually some of our best marketing, which sounds very odd to say, but previous to what was happening here, we had a lot of people moving here. And if you don't know this, there's a lot of buses that go from the ABE market to Philadelphia, to New York City, to New Jersey. So there's just so many more and more people. We had a light winter this past year, and we have a significant amount of farmland around here. So all of this made this, I'd say Q3 and coming up Q4, very, very, very active. Multiple offer situations, lot of residential and commercial properties going over asking, things like that. John, do you want to round that out with some of your pieces?
Yeah, just, basically, if you think of the Lehigh Valley economy, it's a rising tide. And again, we're in a fundraising stage, and we want to be able to take those investors' funds and invest them in the community. So there is, I think I'm up to 25 now asset types that we would look at. The fund, and again, if you look at the PPM, it tells you what we can invest in. And, so there's just such a multifaceted economy. If you add in government activity, and of course, they're in the real estate business. I read a whole proposal with regard to, creating a new fire department in one municipality, and on and on and on. So, yeah, I agree wholeheartedly with what you're saying, Tejas, and we'll continue to look at every opportunity to make a good return.
Thank you, John. Appreciate that. Move on to the next slide, please. So going into some of that detail, Jeff Sella won't say this, but he is a diamond in the Lehigh Valley, and not that many people know about him and his company. It's been like kind of a trade secret for a while because, you want to keep who is helping you get through your projects and things like that to yourself. But the Conquest Funding Group has been amazing, and I have a lot of clients and my teammates. There's about 12 of us, 12 teammates that have clients. We refer business to them. They have just a fantastic reputation, and they know exactly what they're doing, how to do it, speed, consistency, trust. With that, Jeff, can you talk about some of your activity and what you've been doing successfully with your fund?
Sure. Just to give you some of my background, I spent 25 years in commercial lending in the banking world, focusing on commercial and investment real estate. I was vice president for a local Lehigh Valley-based bank where I built and managed a $50 million loan portfolio. So I took what I learned from the banking and commercial lending world, and I moved it into the hard money space. I don't particularly like the term hard money. I like to call it alternative lending. But I approach loans just like bankers do. And so we spend a lot of time getting to know our borrowers, understanding them, understanding their financial situation, their experience level, because we want successful borrowers. And I don't know that most hard money guys care that much. From what I hear, they typically look at asset values, and that's pretty much it. But we take a very different approach. We have identified the key factors that make for a successful borrower. And of course, we look at the project to make sure it fits our lending, but the borrowers really becomes the key. We also have a property inspector who goes out and photographs all the properties before and during and after the renovation process. So we do check on those things. Conquest Funding was started in 2010. We opened our first fund in 2011 under Reg D. We opened a Reg A fund in 2018, and we had state and SEC approval for the Reg A fund, as we talked previously. I will say that both of our funds have great track records. We've never missed a payment to any of our investors. And right through the COVID-19 shutdown, we had reserves in place, and our borrowers came through as well. We had very few issues with borrowers. Most of the borrowers paid on time. And even now, there's no residual effects from the COVID-19.
Hey, can I jump in real quick? You said it's highlighted there and it's capitalized, and not that many people can say the word never. Can you repeat what you stated there?
Yeah, we have never missed a payment to any investor in our 10 plus years of operation. And that's a big deal for us. Our investors are our first priority, and we take that very seriously. And everything we do, we look at in terms of how does it impact investors? Is it good for the investors? If it's not good for the investors, we're not going to get involved with it. And I often say, I heard it quoted from you guys now, is quality over quantity. And so I'm a big believer in doing it right and doing it well.
Well, let me jump into that again for a second, though. You're talking so much about the borrower and the projects, but these projects are local projects, ABE market, and I can be candid because I know some of your clients. They're not buying, they're buying a pretty ugly property, right? And they're pumping a bunch of money in there over time, and they're trying to get in and out of that project as fast as possible, but also build the quality work that you inspect. And then typically it goes to the rental community or something like that. You want to kind of respond to that?
Yeah, exactly. So that exit strategy, as you're talking about, becomes so important. What is the borrower's plan to pay off our loan? What is their plan to renovate this project? Is it going to be something they're going to flip? If that's the case, obviously the quality of the renovation project has to be much better than if they're going to just rent it out. So typically we have those two types of borrowers. They're either flipping the properties or they are building rental portfolios. And those that have to refinance become under more scrutiny because we want to make sure they've got the credit history, the cash reserves, and all those kinds of things that the banks want to see. And I actually do some consulting with some of our borrowers, how to structure the finances to make themselves attractive to bankers. And it's worked very well for those that want to listen and do it the right way.
It's awesome. Thank you, Jeff. And so about my side of it, we did pretty well. And what my job has been is two things. Basically fix and flip and buy and hold. We're very heavy in the multifamily commercial space, and a lot of the fun is the secret sauce. So I can't share everything, but we're inventory experts. That's what I like to call us. And that comes from a couple different ways we've procured our business. And because I've talked about COVID a couple times, some of the clients that we represented in the marketplace, when we list a property, we don't take pictures with cell phones. We have full drone 360 virtual tours, aerial photography, all of that. And we've been doing that for 2 years. So when COVID attacked our real estate system here in Pennsylvania, my team and I didn't skip a beat. We were able to continue to send them the virtual tours, sight unseen offers, things like that. It was difficult to navigate, but that's kind of what we've built here. So on the listing side, we have a lot of clients that appreciate what we do. We give them a very high sale to list price. My team and I averages roughly 97, 98% sale to list price. And most of our listings across multifamily and commercial are sold within 30 days. So that's our reputation. We want to get people the best amount of money, most qualified buyer. On the other side of it, we are finding properties for some of our buyers outside of the conventional methods, and we're able to buy them at an extremely significant discount. So when you're looking for inventory, you want to make sure that you buy it at the right price. And some of those key things that David said that really people don't want to deal with is management, maintenance, tenants, evictions. Some of those things, and we don't want to deal with that either, but as you can see, we really try to perfect what we're doing and measure the risk. So my conclusion here is that James and I have been returning 10 to 15, sometimes 16% cap rates from a 4 to a 28 unit property. We just literally sold a 28 unit property, we helped purchase a 28 unit property at a 13% cap rate. So that's what we've perfected. And I can talk about this all day, but we're pretty decent at finding the inventory and making sure that we represent the sale in the right way. With that, please continue. So we're not trying to be supermen or superwomen. We're just trying to we're trying to perfect our business plan, we're trying to execute our business plan that we have perfected. And I can say perfected because every component of what we have presented and what we're doing has already been trialed and tested many, many times and has been successful. But I'd rather have John summarize this if you don't mind.
Yeah, I just, in kind of wrapping up, there's things you've already heard that I'm just going to emphasize. Quality over quantity, due diligence, risk management, asset allocation, and using kind of the funneling approach. So with all the properties that Tejas is able to source, with all the loans that Jeff is able to source, they need to be identified, analyzed, sorted, put through our metrics so that we're better able to choose the right investment for the fund and return as you can see there, what our private placement memorandum says to our investors, not only initially, but over hopefully a long time. So.
Awesome. Yes, that's the goal. And I'm going to wrap this up with our next slide. If you are interested or want any more information, we're very, very accessible. We are all here in the Lehigh Valley, local. John's about an hour away in Philadelphia. And the fine print is available. So we want to share this business plan and this information and show you all of this. We'd love an opportunity to present it. And because we're only talking to accredited investors, you can easily verify with our investor credit check, and then there's an onboarding process. It's a lot of fun, and for my purposes, I am excited to share with our investors the properties that may or may not make the list because of analysis. You know, I like to be open about what we're doing, whether it's a client on the real estate side or on this side. That's really kind of the fun that I look forward to. So with that, thank you very much, and I'll hand it over to you, Jim.
Great. Thank you so much, Tejas, Jeff, and John, for sharing all that. That was great. At this time, we felt it was helpful to talk just briefly about using real estate investing in a self-directed IRA.
Let me jump on that. And so David had mentioned self-directed IRAs are a great investment vehicle for real estate. And they're also a great investment vehicle for non-traditional investments. You need an IRA custodian company, which allows self-directed IRAs to invest in non-traditional investments. Custodian companies do not offer any investments. They simply handle the paperwork to keep you legal with the IRS rules. And the IRS has some very restrictive rules on direct real estate investments. So when your IRA becomes the owner of a property where you take a title in the IRA's name, your IRA must pay for every expense directly. You cannot reimburse yourself for any expenses that you pay out of pocket and have your IRA reimburse yourself. That is not allowed. You cannot do any work on the property. You can't pick up a paintbrush. You can't put up drywall, anything. You have to hire a contractor and pay the contractor from the IRA. So there's a number of different rules and a lot of paperwork and documentation that you have to keep. So, you know, my way of viewing this is the easier way is to invest your IRA into a fund like the Lehigh Valley Private Equity Fund. Your IRA will receive quarterly distributions, or you can compound your returns and let it grow over time. And that's really it. You don't have to worry about all that other stuff. We work with several IRA custodian companies, and we will help you make the switch. So we'll get your account set up. We'll help you transfer the funds and make the investment into Lehigh Valley Private Equity. And we've been working with IRA investors for many years, so it's a relatively simple process. So if you want to know more about it, touch base with us, and we'll help you get that started.
Thank you. So this ends the presentation part of the webinar. And now our panelists are available to answer any of your questions. We'll route your questions to the appropriate panelist, unless you specifically want to ask someone a specific question. First and foremost, is capital preservation. Investors want to make sure that they want the return of their capital before the return on their capital. So if an accredited investor has several $100,000 that they want to invest in the fund and take advantage of all the positive market signals that are lighting up throughout the Lehigh Valley that was just presented, and take advantage of several of these great opportunities. From an asset allocation perspective, what type of asset classes would be the bread and butter per se that the capital will be deployed into in order to generate the preferred and target returns?
Yeah, John, you want to start with that?
Yeah, let me just say that, there was probably more of a tried and true answer to that question up until about February of this year. You may or may not know Warren Buffett lost $50 billion in the quarter. And, I would say that, again, different kind of market. But so from a asset capital preservation standpoint, I think one of the most, and Jeff, you can join in here, but one of the best capital preservation protection is not being able to sell on every whim or stock market increase, decrease, on every economic number that comes out. And being able to weather the storm by doing nothing but maintaining your investments. And, you know, the investment in the fund is a long-term investment. There is a lockup period, which you'll read in the PPM. But as you've noted, and I'll use the stock market as an example because it's probably the most liquid of markets that we read about, took a dip from roughly 2,900, that down to 1,800, 29,000, down to 18,000. A lot of people panicked. A lot of people sold their stock, and now it's back up to 27,000. So real estate is a completely different animal. And I'm not going to sit here and say that if you had an investment in a hotel property, that the value of that property today is different than it was before COVID-19. But it's not something that, from the standpoint of the fund, that we would look to sell. But we would look to possibly buy, to take advantage and be opportunistic, as Tate just said. And so capital preservation is an ongoing process, an allocation process. As you may want to know, we weren't affected by the virus. We are, because we did not launch the fund before. And so in terms of still acquiring assets with all the information that we have now on people's habits, helps us to maintain. Having said that, you know, these what they call black swan events are difficult to predict. Having said that, real estate is traditionally an investment area where you can buy and hold, you can restructure, and preserve that capital. Jeff, do you have anything to add?
Yeah, on the lending side, we've put a number of policies and procedures in place, and we lend at 65% loan to value based on an after rehab appraisal. So we get all these projects appraised based on the scope of work, the construction estimate, and we want to know what they're going to be worth when they're finished. And we typically lend at 65%, in some cases 70% for better borrowers, but generally 65 is our target. We also want the borrower to put 10% in of their own money. You know, we want to make sure we're dealing with qualified borrowers, so we get their credit histories, we look at their bank statements, we get their financial statements, tax returns, and we do a cash flow on them. We want to know what their real estate experience is. So we have a number of things in place to make sure that, one, we've got a good borrower, and two, we've got a good project. And so we think that that has been working very well in our favor over the last 10 years. It has really eliminated some of the issues that hard money lending has in terms of these properties and these borrowers just kind of walking away. It's pretty rare for that to happen in our portfolio. In fact, we've never had anybody walk away from a project. In 10 years and 380 projects, we've only ever taken 2 back.
You say never?
We've only taken 2 back in 10 years. About 380.
I'll jump in too. So, you know, he said 2 things, borrower and projects. So we are trying to get borrowers into our fund, well, investors, right? So that we can take the money and deploy it into the market. Project wise, you know, 4 units to 20 units, that's our specialty in the Lehigh Valley. And I was previously in the hotel world, so anything up to 200 units in this market, I can safely say, you know, we don't really look at anything in the 3 and lower range, but we have a really good reputation. And, you know, we really kind of, I wouldn't say cornered the market, but we have a good grasp on the inventory that we're looking for. So my goal is to bring in as many pieces to look at that we can take under control and make sure we return a strong in investment rate too.
Thank you. I think that answers that question. It sounds like everything you just said, it sounds like a solid risk management portfolio plan across the board. Okay, so we are coming to the end of the webinar. So this next slide, as promised from the very beginning, And also I've posted in the chat box to the right of the screen. This is how to get in touch with David, Tejas, Jeff, and John, and also myself. Just give you a few seconds to jot this down. This video, we also mentioned, will be on our website and posted throughout social media. Perfect. So that wraps it up. We at Real Estate Investor MBA want to thank all our panelists for sharing their expertise and information with everyone today. Remember, we'll be having another webinar on Friday, August 21st from 4 to 5. And the new series, this will be Investment Series Part 2, How to 1031 Exchange Real Estate right here in the Lehigh Valley. So if you want to join and haven't signed up, please do so. We'll be sending out links for that webinar later this week. And if you also know anyone or other accredited investors who are interested, just let them know to look out for the invite. Hope you have a great day.